You have seen couple of my classes where I have discussed the very basic concepts of bookkeeping. Most of the concepts are related up to preparation of trial balance. I have never discussed anything, any higher concept. Maybe one or two problems have done. But today I thought we will discuss the very important concept. Most possibly, this is the last lesson in A-levels. Investment appraisal. So, investment appraisal techniques, very important. Every alternative exam, every exam, at least one question, and even some business studies questions will appear. So, what is this class about? This is a live session. So, let's discuss the very concept itself. What is investment appraisal? So, the businesses, before we start a business, we need to identify whether the profit, whether it is profitable or not, whether to start a project, whether to start a business, we will incur loss. So, without identifying that starting business is not advisable. So, even if you have started a business, you may have to suppose if you want to start a new business, you may have to appraise it. We have to identify whether to start the business or not. So that is it. So there are several techniques where you need to identify to find out whether a business is profitable. It's very important from the perspective of business, from the perspective of examination. So whatever I discuss, we discuss with perspective of examination. But we need to understand the very logic, because if you understand the logic, you can do any damn problem. That is my perception. That is my perception. So if you understand the concept, you can do any damn problem. Any damn problem. So whichever it is. So normally the questions will be very similar, very simple, and they are very easy and easily scoring. So, but most of the students they get confused. They get confused with some aspects. What are those aspects? The very first concept which you learn in this is AR, accounting rate of return, average rate of return. So I call it by whatever name. So it is actually accounting rate of return. We call it as average rate of return also. I call it simply, I call it AR. So there is something known as discounted. What is discounted? Sometimes they call non-discounted also. So what is non-discounted? And with the very concept, the formula itself. So what is ARR? Average, simple, that's all. So average upon average, average investment, average return upon average investment. That's all. That is the formula. So you need to learn this formula. You don't have to even learn the formula if you understand the concept. So ARR is simply nothing but average. That's all. Average rate of return. So you calculate the profit and you find out what is the return on any investment. So that's all over. The case is done. So why you need to learn the formula? People spend a lot of time spending the formula just to learn the formula. They take a lot of time, and they don't understand the concept. Sometimes they think whether we have to discount or not. Yes, why? Because as an overall result, you need to discount in NPV, you need to discount IRR, you need to discount NPI. So because of this, here also you may think whether you need to discount or not. So we will discuss what is discounting itself. So why discounting? What is the very concept of discounting? Why discounting? We will discuss even that. So next, payback period. So what is payback period? So again, whether it should be discounted or it should not be discounted. What is discounted payback period? What is not discounted payback period? Why we discount? Why we not discount? The very concept again. So what is payback period? Payback period is nothing but if we start any business, in how much time period we are going to recover whatever we have invested. So that is what is payback period. Then NPV, net present value. So net present value. So the very concept of cash flows. The very concept of cash flows. What is cash flow? Cash flow is actual what is coming into the business. What, how much of cash, whether it is cash balance, bank balance, whatever. So whatever, how much of cash we are going to receive and how much of cash we are going to spend. By starting the business over a period of time, what is the net present value? What is the net gain? What is the net inflow or outflow? So that is what is NPV. So what is IRR? IRR is the we will recover the investment. At what rate? What should be the rate of earnings? What should be the rate of earnings to recover the investment within a specified time? Within a specified time. So, and there is known as something known as PI, profitability index. What is profitability index? Profitability index is normally used for capital rationing problems. What is capital rationing problem? Suppose we have some alternatives. Suppose we have some alternatives like we need to identify which project or in which there is a choice in front of you. There is an option. You have an option to choose several projects. So which is the best option? Which you have to use first? Which in which investment? In which project you have to invest first? Then in which project? Then in which project? And the funds will be exhausted. Since we have limited funds, so that's why capitalization. So to identify in what is the ranking, to identify the ranks in which the projects to be taken is profitability index. So then appraise, and ultimately in the end we need to appraise and we need to give a judgment based on this whether the profit, the investment is feasible or not feasible. It's very important lesson. So from the examination perspective and from learning perspective, financial management. So this is an important topic from financial management. So this is not there in the lower level, that is AS level or IG levels, whatever. So this is ultimately the last lesson in A levels, and it's very important. So we need to understand what is. So the students they get confused just because where to apply discounting factor and when not to apply discounting factor. It will sometimes they will specify, sometimes they won't specify. For example, they may ask calculate discounted payback period, but sometimes they just say calculate payback period. So what to do? The students get confused. Just because of that, they lose marks. They end up doing wrong things. So you need to understand the very concept. So what is discounting? That is the first lesson we are going to learn. What is discounting? What is discounting? After all, what is discounting? What are those numbers? We need to understand. Actually, the numbers will be given to you. You don't even have to calculate the numbers. But if your concept is clear, then you know everything. You need to know the concept. If you know the concept, what is discounting? what is present value, then the job is done. So let's start with the very basic concept, the very first concept, very important concept, discounting. This is in 2030. So we are talking about the future outlook, but is the value same? Is the value same? Suppose you buy this pen today. Suppose if you buy this 10 pen today, let us say it is worth $1. After 1 year, will the value of the pen be same? It may be, let us say it is $2. So can we say that the value of dollar has come down or the value of pen has gone up? So we think that from that perspective, the value of the very dollar itself when compared to the value of pen, that is what is present value and future value. Future value 1,100,000 is future value, 200,000 is future value, 300,000 is future value, 2,500 is 250,000 is future value. But we don't know what is the value if we get it today. So when we try to find out the value, when we express these values in terms of today's values, that is known as present value and that is known as discounting. Still not confused. Still not clear. Okay. So we'll just explain. We'll just discuss that. Okay. So we'll discuss. Suppose, let's say you have 1,000 bucks in your bank account. This is 2025. You have invested this in a bank that will give you 10% return. 10% return. 10% means you will get profit of 10%, interest of 10%. So after 1 year, you will get 100 at the rate of 10%. If you deposit 1000 today and if the banker is giving you interest at the rate of 10%, the amount is $100. The value of $1000 after 1 year is $111. So that is 1000, the initial value plus 100. 1000, the initial value plus 100. Suppose you reinvest this again. Suppose you reinvest this again at the rate of again let us say 10%. So normally that it is considered that the rate of interest is constant. Normally, so all cases, most of the cases, 99% of the cases, the rate is constant. Whatever they give rate. So suppose if they are given 9%, it is 9%. If they are given 10%, it is 10% throughout the years. Means even if you take for 10 years, the rate of interest is same. That is what is normally assumed. That is what is considered. So don't overthink, oh, what if the interest rate increases or decreases? No, keep it as it is. So you don't have to consider about that. So consider this. So what happens after 1 year? Again, when you invest it, so you get it at the rate of $110. You get $110. So what is the next year value? So this plus this will be 1, 2, 1, 0. So let's keep it simple. So this will be 1100 plus 110. So let's keep it simple. Just we'll take it for 2 years. So it may be any number of years. If you just keep continuing, it will keep increasing. So you need to just add 10%, 10%, 10%, 10%. So that is what is this is known as future value. This is future value. What is future value? The future value of 1000 today after 1 year is 1100. The future value of 1000 today after 2 years is 1210. That is what is the meaning. That is the meaning of present value and that is the meaning of future value. So what is discounting? What is discounting? They might have given you, we know these values, we know these values. But these are the future values. What is the value today? What is the value today? Very basic maths, very fundamental maths. You don't have to understand mathematics for this. It's very simple. Here you are multiplying. Here it is 100, 1000 into 1.1. 1000 into 1.1 is 1100. 1000 into 1.1 into 1.1 is 1210. So this is how the numbers, we may play with the numbers. It's very interesting topic. It's very interesting, very simple logic. So try to understand the concept. Whichever problem you do, try to understand why you are doing what you are doing. So that's the concept will be clear. Sometimes this is very significant. You have to calculate the present value. You have to calculate the future value. You have to calculate the present value. It's very significant. In some cases, it's very significant. So that's why in those cases, you have to calculate the present value and the future value. So now, how to calculate the present value. So the value of 1000 after 1 year is 1100. The value of 1000 after 2 years is 1210. When you understand it in a reverse way, when you understand it in a reverse way, that is, the value of 110, which is after 1 year, this is after 1 year. The value of 110, 1100, which is after 1 year, today is 1000. How is it? 1100 divided by 1.1. There you have multiplied to arrive at future value. Here you divide to arrive at present value. So how do you do this? So what is 1 divided by 1.1? Just check. 1 divided by 1.1 is nothing but 0.90909. So that is why we multiply these numbers with this to get this number. So what is the value of 1210? The value of 1210 after 2 years is the value of 1210 after 2 years is 1000. How? Again the same thing. 1210 divided by 1.1, again divided by 1.1 gives, that is 1 divided by 1.1 divided by 1.1 tends to 0. Just calculate what you get. That is what is discounting factor. When we express the future value in terms of present value and the number with which we multiply, we have to multiply. When we multiply 1100, with 0.9090, so you get back 1000. Simple. That is the whole concept of present value, future value, discounting factor. Discounting factor, the value, very principle of discounting factor. Very simple, very simple, very simple, very logical. That's all. Simple, that's all. So this is how our classes will be. So we will have live classes, daily basis, live classes daily basis. Sometimes I may not be available. So in this week I am not available from 15th Jan 15th Jan to 17th Jan. 15th Jan to 17th Jan. Maybe even 18th Jan, but we will resume after that. So daily basis, tentatively from 6 a.m. onwards. So I will never assure you when we will be ending up the sessions. I am not sure, but once we start, it will be very continuous classes. We will be discussing very important concepts. Where we will discuss question papers, the concepts related to question papers, how it is done, what it is, why it is done, everything. The very concept, so that you understand and make the class very interesting. The class will be very interesting. We will have interactive sessions. So keep in touch, keep in track. So we will continue. So since today is the first session, just wanted to introduce to you the very important concept so that you catch up interest. So never miss any of the classes if you want to perform better. That's what I can say. So we will discuss the other concepts. We will discuss the other concepts in the later classes very soon. So subscribe and keep watching. Till then, have a good day.